Bitcoin itself gives you multiple opportunities that the ETF does not. So, for example, you can self-custody it, you can bring it around the world, you can use it for its monetary purposes. But not everybody currently needs or desires that use case. So, if you don't foresee that you're ever going to want that use case, the ETFs can make sense for people. They have retirement accounts, they have managed assets, they have traditional brokerages, and so to the extent that the ETFs are now an
Experts
option.
disagree on the U.S. economy's future and how to stop the unsustainable budgetary path. The U.S. national debt has climbed by $1.2 trillion since mid-September, more than twice as much as 12 years ago. The value has risen by about $7 trillion since February 2020. The national debt was $97 billion years ago. Next, $33 trillion in debt took less than 50 years, but the previous trillion took nearly 200 years. Everyone thinks we have a major debt problem that needs to be fixed immediately, but experts disagree on how. Federal Reserve Chair Jerome Powell agrees that the U.S. is on an unsustainable fiscal path, but he thinks politicians should just have an adult debate about it. For other macro analysts and famous investors, there's no solution. These people realize the U.S. is deeply in debt and will likely enter a long-term downturn, but they also know there may come they believe no U.S. official will propose or support tough austerity policies. Recent Skybridge Capital's interviews confirmed this. Stephen Scaramucci, famous macro guru and financial expert Lyn Alden, argues the U.S. debt situation might go two ways. The first is that technological advancement will generate deflation and productivity to cover the debt. Raoul Pal, Real Vision CEO, proposed this idea recently. In this environment, the U.S. continues to have financial problems until AI fixes productivity and population issues. The Federal Reserve prints a lot of money to pay off its debt in Alden's second scenario, but the currency loses value even faster. Alden discusses the U.S. debt crisis and how investors might survive with Anthony. Interview excerpts follow. Like and share this video, subscribe to the channel, and enable post alerts for more.
There's two main outcomes. If there's enough technological development, so in other words, enough deflationary pressure, things like AI, or making sure we continue to have abundant energy, for example, then you can get a case where the current status lasts a very long time in the sense that deficits keeping running. Every once in a while, they're monetized to a significant degree, and inflation is, largely offset by the gains in productivity. And the downside of that scenario is that those who own financial assets keep benefiting and benefiting and benefiting, and you keep widening this existing gap we have. Basically, you continue the past 40 years, and you probably get more and more political polarization until you get some extreme nonlinear events. Basically, the rate of those starts to increase decade after decade, or at least the probability of those starts to increase decade after decade until you get unforeseen circumstances. That's kind of one scenario. The other scenario is that if you do run into more acute energy shortages. We don't do sufficient energy capex, and say, for example, we have a major multi-year sustained bull market in energy prices, or AI does not live up to the productivity gains that the bulls expect, for example, and doesn't offset some of the inflation enough, then you can get more acute issues where you get things like yield curve control. You get major currency devaluation relative to commodities or relative to consumer prices, and you basically get a restructuring of the debt. I mean, there's two major ways to default on debt. One is you can default on it just outright, and the other one is you basically print the difference, where you technically give all the units back, but all those units buy a lot less than they could before. It's not the same unit that the contract holder expected when they bought that bond. And so I think one of those two outcomes, basically in either way, it's generally not great. For someone who's not prepared for it. You're either not owning financial assets, kind of overall kind of ownership of things that are scarce and cash flow producing or just useful, or you own those and you get devalued. So it's a really kind of challenging binary outcome that's largely based on how powerful those deflationary forces are.
While currency debasement is worse in developing economies right now, Allen thinks it will only be a matter of time before it affects all countries. Many new places around the world, from Egypt to Nigeria, according to Alden, countries like Argentina, Sri Lanka, and Zimbabwe are dealing with terrible inflation and unbelievable rates of currency debasement. This could happen to many developed countries in just a few years if governments keep printing money without thinking about it. What we think of as strong currencies now will only be worth a small part of what they are worth now. Plus, you can't avoid or hide from currency devaluation whether you invest in traditional assets like stocks or bonds, run a small business, or depend on your wages to support your family. The struggle is always how to keep up with the rate of devaluation, which is something many people never manage to do. That's why Alden and Anthony strongly suggest investing in Bitcoin, which is a decentralized, trustless, and permissionless network instead of the highly centralized, permission-based traditional finance system. Here are some more clips from the interview.
Biggest divergences between fiscal policy and monetary policy in recent memory. And so the general tightness of monetary policy is higher than normal. And at the same time, the looseness of fiscal policy, meaning the size of the deficits, especially relative to the size of the economy, is larger than normal, especially outside of a recession. And so that gap is resulting in sectors performing like their divergence in performance almost couldn't be wider than it has been in history. So, for example, things that are not sensitive to interest rates, at least as much, like profitable tech companies or restaurants and travel, things like that, they're generally doing quite fine. Whereas when you look over at, commercial real estate or unprofitable tech companies or things that in general are either highly reliant on issuing equity or highly reliant on, kind of shorter, moderate term debt, those are the industries that are really struggling. Especially if they've also been impacted by changes, things like work from home. And so everyone's kind of focused on the question of recession or no recession, whereas I'm generally finding that some sectors are already deep in recession, whereas other ones are booming. And so you have to kind of answer that question on a sector by sector basis because you have this bigger than normal gap. And so the FOMC meeting and also the Treasury announcements this week were informative. They showed us a slight diversion from the trend we've seen over the past quarter. So the past couple quarters we've seen larger and larger fiscal deficits, a lot of bond issuance, especially a lot of short duration, like bill issuance, which is really good for liquidity. And we've also seen the Fed get more dovish over time. They kind of finally eased their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table and they kind of delayed any sort of dovish action outright. And so I think we're seeing a little bit of a consolidation with expectations going forward. But I think the overall structural view is still the same, which is that you have relatively tight monetary policy and you have relatively loose fiscal policy. The view of either no recession or soft recession, or and the way I describe that is kind of sector specific recession or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed markets. So when people think of recession now, they often think of either COVID or they think of the 2008 financial crisis. Whereas, for example, if you go back to the prior recession, you had the 2001 recession, which was obviously very bad for equities given how overvalued they were. But the actual recession itself was quite mild in terms of the unemployment rate, in terms of the GDP contraction, in terms of what other sectors did. It was not a very severe recession by most metrics. And I think that to the extent that we do get a recession, and I admit, in 12 months, there's a lot that can happen. But to the extent that we do get a recession, I would expect it to be more like that 2001 variety, where some of those unemployment statistics and some of those GDP contractions are maybe not as severe as people fear. But that, of course, can still have very big implications. I think one of the biggest concerns in the markets is that a lot of the bond proxy type of equities, so kind of defensive, high quality equities, a lot of them have been bid up to very high valuations. Costco, for example, it's a great company, but the stock is trading at valuations that make it look like they're doing AI or something, right? And so you have
Exactly.
that problem. Yeah, and you have that problem where if you get even a middling economy, let alone a slightly recessionary economy, those valuations are just hard to justify at these very high levels. So I think it's very sector specific out there. My expectations probably somewhere the same, although I admit that I'm not really sure because right now, when you're in inflection points, it's harder to judge. When you have a firm trend in place, it's easier to extrapolate that. So, for example, in early 2022, my view was quite bearish for that year. And we had, purchasing managed indices like PMIs rolling over. We had liquidity indicators rolling over. It was a very bad year for most risk assets. But around kind of either late that year or especially early 2023, I started to inflect more positively. saying I'm kind of flat to up now. As we go into 2024, I'm less bullish on markets in general than I was last year, but I'm not exactly acutely bearish either. And the problem with forecasting the economy is that we're seeing most indicators like PMIs have bottomed, but they're not really showing signs of rolling up yet either. One of the biggest comparisons is probably late 2019, where you had PMIs and other indicators were kind of stabilizing, starting to roll up, and then they got hit by COVID
Right.
in early next year. So you never really know if a trend's going to continue. I'm seeing divergences where, for example, the labor market is finally starting to show some more notable weakness, you could say.
Hmm.
On the other hand, liquidity indicators are actually starting to show signs of rolling back up. And so I still place this as a pretty high uncertainty environment where I don't really expect the extremes. So I don't really expect a gigantic recession. I don't really expect a raging bull market this year. And my view is unfortunately pretty wide in the middle because we have to be honest when we have kind of high conviction directions and some of those more neutral directions.
Lyn Alden says that the many problems the economy was having started to show up in the 1980s when the national debt went over the dreaded $1 trillion mark. Mark Allen thinks that the rapidly growing debt would have had bigger effects at some point, but the U.S. economy was able to stay strong enough to keep its size above the interest costs on the country's rapidly growing debts. These factors include rapid globalization, a period of significant productivity with about 1 billion people entering the global labor force, lower interest rates, and peak demographics in the U.S. with the large baby boomer generation entering their peak spending years in the 1980s and 1980s and 1990s. Alden says that policymakers have been able to kick the can down the road so far without any major consequences. However, those problems are now coming back, but they are much bigger and worse because of the much higher debt to GDP ratio. Also, unlike the 1980s and 1990s, all the things that kept the economy going are either falling apart quickly or happening much more slowly than they did back then. Alden says that as a result, the U.S. economy is now in a very dangerous position and is on the verge of disaster. Alden suggests that investors protect themselves against the coming crisis by investing in Bitcoin, which is one of the few assets that has done much better than currency debasement and will continue to do so. What do you think about Lyn Alden's assessment of the current state of the U.S. economy and what's to come? Please leave your thoughts and comments below. Also, don't forget to like this video, subscribe to the channel, and turn on post notifications to see more videos like this.